Nervous about the volatility of public markets? Looking to invest in Canadian real estate but not finding the right opportunities? Neighborhood Holdings may be an option. Nearly 10 years of consistent performance, Neighborhood aims to provide stable income while preserving invested capital, target net yield above 8%. At the heart of the strategy is Neighborhood's mortgage product portfolio of first position 100% residential mortgages across Canada with an average loan to value under 55%. Neighborhood partners with mortgage brokers and financial institutions to support quality borrowers in transition who may not currently qualify for traditional financing and have a temporary need for capital. Neighborhood's portfolio has no exposure to commercial, construction, or bare land properties, is geographically diversified across major urban and suburban centers in Canada. Check out the links in the description or visit neighborhoodholdings.com to view the offering memorandum for investors and advisors or to explore mortgage broker partnership opportunities. This is not advice. Please consult a professional advisor before investing a loonie in any of these investments. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble.
Welcome back to the Loonie Hour, episode 205. As always, joined by the three amigos. We got the Boomer, not in Halifax, over in the Swiss Alps. Rich Tia has...
Yes, and me.
New art walls coming together.
It's coming together. Yeah, shout out to Ken Dryden, by the way, who passed this week. He was my late father's favorite player. He was a gentleman and a scholar. And he was a good guy. So that's it. Yeah, the art wall has, you can see him. He's there.
Ken Dryden. I think Patrick Waugh was better.
Oh boy, 6 cups in 8 years. Anyways,
Steve's too young to even know who Ken Dryden was.
Yeah, exactly. But
yeah, absolutely.
How you doing, Keith?
Good. Yeah, I think I had my first shower in 6 days today. I'm over here without a lot of time, everyone. But I'm over here in the it's at Ladabrunnen Valley. So the main towns would be Bengen, Murin, Grindelwald, places like that. I know a lot of you listeners, a lot of people listening have been over here. But it's just great. Mrs. Icecap and I were hiking up and down the Alps, having lots of fun. Exhausted after every day, but it's just been outstanding. So really good time here, and it's getting late at night though, Steve. So no slow talk today.
He wants me to wrap it up. What are you doing every day? You just hiking?
Yeah, every day we're hiking. If you're in the hiking world, we're like distance is important, anywhere like from 10 to 20 kilometers probably, but it's the vertical gain. Like we're probably doing anywhere from 1,500 to 4,000 feet, like in that range. Yeah. Hey, one little place we went to, it's way out in literally at the end of the valley in Glacier. It's called Hotel Obersteinberg. But it's it takes a long time to get there. There's no electricity or anything. The place is powered by candlelight, basically. So it's a really cool night there. Great food, but you're just staring at glaciers and big waterfalls and stuff. Anyway, everyone having a good time here.
What do you do? You pack a Brunello in your backpack or what?
You can get those just about anywhere. And Rich, this is for you. Like, look how big this bear is relative to my head. It's like I have a big head too. It's like 3 of them combined.
He's violating the rules. We have a no drinking policy on the pod now.
Yeah. Anyway,
it's just for show. Just for show. Let's go.
Anyways, Keith, it's funny. We talked about it like in August, like, like summer, dog days of summer, not a lot going on, but just wait till like the fall rolls around, September, things are really going to get kickstarted. And I think that's been very, very accurate so far. I mean, just the litany of data that's coming through, the shifts and changes in markets and geopolitics. And yeah, it's been a really crazy busy news cycle. We got the BOC on deck September 17th. We'll chat about that. We just had the ECB. We had a ton of data coming out of the US, Carney government coming out and talking about the energy projects of sort of national importance, I guess. Developments in China, Poland. So we'll do our best to kind of walk through all that this week, but I wanted to tee it up to go over the BOC next week. All our variable rate mortgage holders, knees are shaking. September 17th, the BOC is on deck. Rich, what are the current market odds?
81.7% no cut, which is down from 90 just a couple of days.
81%.
You mean cut?
sorry.
You mean cut?
Fuck, sorry, I screwed that up. Oh,
It's
now it's
Loonie Hour math once again, through Rich.
Sorry. Let me start over. So the meeting is 17th of September, and it's at 80.3% of probability of a cut, which is down from 90 last Friday. We'll talk about why in a second, I'm sure.
Down from 90, so there's a chance.
There's a chance. So you're
saying there's a chance.
do you guys want to? Who wants to take the first stab at the Twinkie bet? It's been a while. It's been a while since we've had one, so they're back.
I'll go. I'm still. I still remember the delicious croissant I had last time. I didn't lose last time. I think I was a winner with that one. But last meeting, Steve, you and I both.
No, it was me.
Expected a cut. Was it you, Rich? I thought it was Steve.
No, it was me.
Okay. And it turns out we're just a little early with it. So I'm down for a cut. I thought they would have started last month. And my reason for that, I just think the Canadian economy, in line with all other economies around the world, we're really starting to see a slowdown in activity across a lot of different economies and parts of the economy and in markets. So I have them down for a cut coming up. I'm down again. Put me down for 25, Rich.
Again. Rich?
Me?
Yeah.
I really want to go on a rant about how cutting interest rates will not solve any of Canada's problems. Productivity growth, CapEx, a bloated bureaucracy, high debts, anti-oil legislation, on and on and on and on, and how negative real interest rates are the reason we got into this mess of housing bubble and misallocation of capital. But it doesn't matter what I think they should do. What matters is what they will do. And I think they're going to betray their single mandate. Remember, folks, that the Bank of Canada is a single mandate central bank. They have one mandate, and that one mandate is to target inflation. It's not like the Fed, which has full employment and a single mandate. And I think they're going to betray their single mandate. And the reason I say betray is because we know that inflation is rising. Core inflation is above target. And we know that the breadth of inflation is relatively high. But I think you can put me down for a cut. And I'm sad to make that bet.
All right. Well, I'll keep this interesting and also go with you and go cut 25 basis points. I mean, it's tough because at the end of the day, market odds are 80%. They were 90% a couple days ago. I mean, the squirmer is not going to go out there and spook markets. I think he's got the Fed behind him to support the cut. And so we've got 25 basis points from the BOC next week. But I guess where we can take this debate is where do we go from here? I guess how many more cuts are we expecting moving forward?
So where are we now? Where are we at? 2.25 now? How do you know what's the race?
Yeah, 2 3/4. So 2.75.
We're at 2.75. Okay, so after this one, we have 2.50 left, Steve.
Yeah.
And sorry, Rich, we're
going to zero, guys. We're going to go to zero. I'm not trying to be funny. We're going to zero, and same with everyone else. And we're getting QE come flying through the Alps and the Rockies, wherever else you're going to be. It's going to be like, again, this financial monetary bazooka, and everything was quiet for the summer, Steve, what you mentioned, but things are starting to heat up right now. But Rich, how can you frame? I mean, you framed it just a couple minutes ago that they have a single mandate, to try to maintain inflation, which, by the way, they can't do it no matter what they try to do. How will they try to spin it then to justify a rate cut when inflation is not going the way it should for them to support it?
I think that they're just gonna blame Donald Trump. I mean, I've been racking my head about. It's actually funny you asked me that question because we don't rehearse this, but that is what I was thinking you'd sort of come to me and ask. And I think that they'll just blame it on oh, we need to provide some kind of liquidity or monetary policy cushion for the fact that the economy is not doing well. And what I mean by the economy not doing well, I mean, we had a horrible GDP print driven down by exports last quarter. Although exports are rising, by the way, in July from the US. We can talk about this some other time. And they're also going to talk about how the employment numbers are really bad, and that's going to have a negative impact on inflation. I think that they're going to give us the biggest whopper of like sophistry and just it's bullshit. They have a single mandate.
You think anyone will call them on it during the presser?
Of course not. Of course not. No, they'll be at no. Here's another Twinkie bet. I bet you somebody's going to ask, why don't you cut by 50 basis points? There you go. I'm doubling or nothing.
Some of the jumbo mortgage. Yeah, but I think you could argue that, like, what they'll argue is the labor market is clearly deteriorating. That's going to result in sort of a lack of demand, which, effectively is disinflationary.
Yeah.
So they're going to be like, well, we're trying to get out in front of this thing in advance to sort of soften the blow, so to speak. Is it, I'd imagine, somewhere along the verbiage that they would use. We had the employment numbers out.
Yeah.
Last week after we recorded. The Canadian economy shed 65,000 jobs in August, back-to-back months of contracting jobs. The unemployment rate up to 7.1%, the highest in 9 years outside of the pandemic. And the share of the labor force without work for more than 6 months is now at levels last seen in 2011. So it's not looking too great.
That's a significant statistic, Steve, because I think we'll reference another country in a few minutes why that's important. But it's, again, we continue to see our economy deteriorate in front of us. So I have a question for you guys. So what was the number? 65,000?
65,000, yeah.
65.5.
And what was the private sector number?
50. Well, if you include self-employment. So private was negative. Oh, sorry, I screwed this up. Yeah, about 50. Sorry.
Did you guys notice or see any large-scale layoff announcements?
No.
I didn't see anything. Steve, how about yourself?
No, I haven't seen anything. I think you just, we're certainly reading a lot of anecdotal stuff that's being posted on forums and social media of people like looking for work and struggling to find, employment.
So the next leg then to look for is when you see the big announcements coming. And if you're a big company, you don't want to be the first one to do it until you have to do it. I mean, again, we're already getting the momentum has already started, and it's bad momentum. It's not great. But the next thing you're going to see a major company to say, hey, we're laying off, 8,000 people, 18,000 and stuff like that. So that's what we'll look for next for Canada.
Sorry, I just want to correct myself. So two things from the labor. So the big drop from last month was something called self-employment, which is a bit of a nebulous thing. Like, are these people part-time workers? Because that was the other section. So are they self-employed? Do they have two jobs? Are they double dipping? That kind of thing. So the big drop was in self-employment. Also with part-time. So part-time fell 59.7 and self-employment fell, 42.6. Again, one quarter is always a bit tough. There's seasonality issues. There's always seasonality issues. There's always a bit of revisions. The key thing for me is, which direction is it going and at what pace is the speed? And I think it is accelerating in a downward trend. And so the numbers themselves, I think, are less important than the overall trend and the direction of that trend, if that makes sense.
When you have a lot of people looking for work and it's taking them now, again, more than 6 months to find a job, Rich, I think this is why you're seeing a lot of the political backlash now, or social backlash brought on the temporary foreign worker program, right? We know that program was just heavily abused over the last 3-4 years. And ultimately, when you have youth unemployment at, multi-decade highs, the social frictions come home to roost. And I think that's what we're seeing now is all the calls, not only from, it's not a right versus left debate, it seems. So you had Pierre Poilievre, who came out clearly on the right saying this program needs to be scrapped, but you have David Eby out here in BC on the left saying it needs to go. It needs to be scrapped or grossly reformed. And, he's out there specifically calling out companies like Boston Pizza and Starbucks, saying that, these mega corporations abusing these programs and not hiring, local Canadians or local British Columbians. And so to see various levels of government from all political stripes coming out and basically denouncing this program, I think is really ultimately
Who's in charge of this again? Who's in charge of this desk?
Yeah, it's
like Canadian bacon, that John Kenny, the guy's going to get the phone call. Said, "Oh no, I got to change it again."
No, let's give David Eby his props. He's not a friend of the show. But I give him credit for coming out and saying, for calling out what is obviously a broken system. Like, it's ridiculous. But you mentioned something really important, which is that fewer people are looking for jobs. And that's something that, everyone always obsesses about the unemployment rate. Not really sure why. I mean, I get it why, but something we don't talk nearly enough about is something called the participation rate, which is the proportion of workers that are employed or unemployed and actively looking for work. And that number, which in Canada for prime age workers has been very, very high, which is a good thing, right? From prime age workers is 25 to 54. And for Canada, it is relatively high compared to other countries. It's one of the things we do really well. If you're in that age range, you are engaged, quote unquote, in the labor market, which is great. And what I mean by high is it's like 88 or 89% of everyone in that age group is active in the labor market. So that's good. The problem, what we're seeing now is that is starting to roll over a lot. So now we're at a 5-year low in the prime age participation rate. And so that means people are being, the language that nerds like us use is something, you're a discouraged worker. Basically, you're leaving the labor force, which if it happens en masse is really bad.
You've effectively just given up.
Yeah.
And if you've given up, then you're no longer counted.
Right.
So the unemployment rate can actually get better. Yeah. With
right. Exactly. So, there's the rub.
So I think we mentioned that before. Like in our world, we always look at the monthly employment number, whereas the newspaper world, political world, they always talk about the unemployment rate. And, I always do the eye roll when I hear those discussions because it's not as important as the number of jobs that are being created. But once again, let's just emphasize how bad that number was last week.
Yeah.
It's a huge number. Yeah. Is it very bad or very, very bad? How many varies?
Yeah. I mean, I think
it's
2
pretty
varies because it's going to get worse.
Okay.
So we need to hold on to a vary.
And throwing a pretty with it as
exactly.
well. But the month before was also a negative print.
Right. But the month before that, now this is getting boring, was a plus 83. I'm of the view that that's going to get revised down. That's a bit of a speculative, that's a guess more than it is certainty. But anyway,
I think the gist is you can have volatility in those numbers, but the reality is like there's a clear trend.
Right.
And that trend is things are weakening, things have weakened significantly. And yeah, there's not enough jobs to go around. And I think the first obvious chopping block is on the immigration side. And we know those numbers are getting revised down. And I think now you have political and social pressures that are going to force governments to adjust these programs as they kind of somewhat already have. Now, Rich, we wanted to point out there was some really misleading data and charts that were put out on social media over the last week that were being recirculated by large accounts. And we had a lot of listeners sending those in and be like, hey, check this out. Is this accurate? And so we kind of just wanted to debunk that because I think it's important. Like we can all agree there's an issue on the immigration side, but we have to get the numbers right.
Yeah, I totally agree. So the immigration up enough without having to screw up the numbers, if that makes any sense. And the number that we've been seeing is this chart that looks parabolic, and it's about international mobility program, the study permits, and the temporary foreign worker programs. And what the mistake that they've made is they did a cumulative addition effectively. So each year gets tacked onto the next year in some capacity. And the problem with that is there's literally, you need to do the net number. So there are people who leave. There are people who come and study and go back to Massachusetts or whatever. There are also, and then there's people who get that net number being rolled over. And it's just it's a stark and crazy graph. And when you see something that's like that, like wild in a sense, you have to like take a step back to look. And so that number that chart is highly misleading. And like I said, the immigration file was screwed up enough. You don't need to sort of exaggerate the numbers. The other thing that I think is really important to note, and friend of the show, Professor Michael Scruderud from Waterloo, would defend the temporary worker program. And I think in some ways, I think he's 100% right. There are places in our economy where we need to import labor from afar. That is unequivocal. The share of high-skilled labor as a percentage of the total foreign worker is relatively high, and high-skilled college and advanced degree. Where I think he failed was to admit that in general, that is a backlash to a broader question about how screwed up our immigration system has been and is, in the sense that we've imported about 2 or 3 million people and have only created about 500,000 new jobs. So let's repeat. So from January of 2023, population growth has gone up 2 million, and there's been only about 500,000 private sector jobs, right? So, and the unskilled chunk in absolute terms of the temporary foreign worker program has nearly doubled. So, so there's some nuance there. I think it's important that we address both that crazy chart, which is totally wrong, Professor Scruderud's point about the importance of temporary foreign workers, and the broader point, which there's been a total F up, and something needs to be changed and reformed in that program.
Keith, I want to circle back to some comments that I know you and I know your humor, and I kind of know your market views in general, but like you mentioned that the BOC is going to go to zero. And I think some people will take that like literally and like, oh my God, they're going to go to zero in the next, 6-12 months. But I think what you're trying to say, just to clarify, is that like rates are going lower. The system is kind of at its end game. And maybe they don't get to zero this year or next year, but it's just an inability to really keep rates elevated to where they probably should be. Correct? Or am I missing something?
That's fine. Like, so I have an investment thesis. I call it collision. And so there's a number of major factors. They're all reached an extreme point, and they're all hitting at the same time. And it's going to splatter. So you're looking at, for example, the political spectrum. You see what's happening politically. Everyone's sharp left or right, and it doesn't matter who comes into office. The fiscal situation, debt situation, is still the same. So you got the political side, you have the social side. Everyone these days to be very careful. If you give a view on anything, you're going to get canceled or something different. But now it's also starting to spill over into, for example, if anyone's following what's happening with Nepal over the last few days, and people say, "Oh,
Can
that's
you give
a
us a
small
quick
country."
overview there? Because I don't think there's a lot of people that are.
So Nepal, if you're in the mountain climbing world, Nepal is number one. These guys have more 8,000 meter peaks than anywhere in the world, because I like that world. But it reached a point where the amount of grifting and political theft from the country by the upper classes, it reached a point where the youth movement. So I think Rich or Steve, one of you guys mentioned earlier what the unemployment rate was, for example, for that level. They just had enough. And basically the government building is in flames. They didn't turn feather, but I think the Finmen, they literally dragged them naked through the streets, basically, shame, shame, shame. But that's how quick a country can be toppled socially, just like that. So you have political side. Another thing with the political side we'll go into, but you have the economy. And the economies ever are grinding tighter and tighter, which contributes to the social stress. And then you also have the monetary policy and then fiscal policy all hitting at the same time. So, when I say, I think central banks are going to go to zero, that's where they're headed. Like, do they get down to a half a point? I don't know. but everyone has become synchronized again. And it's all because, well, we have to bail out the economy. We have to bail out the government. And the real challenge here is that, we went to extreme monetary policy 15 years ago. And the only thing that did, and Rich, you talked about this a lot, is that it created a bubble, or it inflated asset prices around the world. And who owns all the assets around the world?
Rich people do, and
Yeah,
old
rich
people,
do.
and
Yeah,
old
rich
people.
and old people. Yeah, and the lower income people, lower households, they don't. So this divide has grown even more, which increases the social stress that's happening, and the political response doesn't help it, because they've been, going these really weird views and policies on things all at the same time. So I do believe we are headed for this moment coming up, Steve, where we're going to see an extreme fiscal and monetary response all hitting at the same time. So starting next week, central banks are going to start cutting these new budgets that are coming out. Ottawa, I know you're listening. Do not release the budget. If you release it, you could blow the country up. Just don't do it. Try to hide it for another year or so. And it's all happening in response to everything else, colliding at the same time. And I think it's pretty easy to see. The question, of course, does the like this fiscal and monetary bazooka, is it happening in response to a crisis moment, or is it being proactive? It sort of prolongs the scenario. But we're headed for some extreme movements. I mean, in France, for example, Rich, share what's happening in France.
Yeah.
As we
Well, I
speak.
mean, Macron's. I always get confused between a prime minister and president, but no, Macron is the president, and the prime minister. Basically, there was a no confidence vote. It was overwhelming, 364 or whatever it is to 100 and something. And right at the exact same time, obviously coordinated, they knew what was going to happen. There was riots. Now, France is not exactly a stranger to riots and political action and street burning and whatever. But basically, I think that was like an effort to put a lot of pressure on the incoming government. And the irony of ironies is, it's basically because they wanted to do quote a super small a austerity, right? Like they're running a 5 or whatever % budget deficit, and they wanted to or like 5.5, and they wanted to lower, like cut the budget deficit by a % or something, right? Like it would still be in huge deficit by any historical standard or cross country standard, and that was considered. Again, I used the small.
It was unacceptable. They want to do the right thing, basically, if you think about it.
They wanted to do the right thing, and of course, everyone freaked out. And what's important to note is that France is one of the highest debt to GDP ratios in the world. They have very, very low retirement age. So I think a couple of years ago, I think it was like 10 years ago, Keith, they wanted to increase the retirement age from 62 to whatever, 64. I think everyone went bananas or something like that. And remember, keep in mind that life expectancy has basically been continuing to grow and grow and grow until COVID. Anyway, but you know what I mean. And so there just needs to be some kind of fiscal reform and restraint, and they won't have it. They just won't have it.
So, Rich, there was an article in the Financial Times this week saying that at 3.47%, French borrowing costs are now above those of longtime Eurozone troubled borrowers, Greece and Italy, two of the borrowers long deemed riskier by global investors.
Yeah, it's really funny. It's actually really fascinating because I was right in the thick of it working for European investment strategy at my old 3 or 4 jobs ago. And we just watched all of the northern European countries basically poo-poo and admonish the pigs, right? So pigs is Portugal, Italy, Greece, and Spain. And you could throw in Ireland as the extra I. And they were just oh, you're reckless. And they leaned on them, right? They leaned on them because the French and the Germans wanted to protect the banks like Crédit Agricole and Deutsche Bank and Landesbank and the other one from France, I can't remember, who were filled to the gills with all of this pig sovereign debt. And those spreads were going up, and spread, inverse to the spread is the price. And anyways, and it's just funny how a quick 10 years later, and the yield on the French bonds is actually higher than it is on Italy, if I'm not mistaken.
It is, yeah.
And that's And Steve and Rich, and that's what just I think it's just incredibly interesting to see it start happening everywhere. And again, like Nepal, like this little country, people, it doesn't matter. For example, the big box banks in Canada say that makes up 0.000005% of the Canadian economy, like something bizarre like that. But is an example of though how fast and how quick a civil movement can take place. Like it can overturn a government immediately. So watch the French, what's coming up. And I mean, the challenge with French, of course, is that increasingly more and more of the economy relies more and more on government. So it's sort of like the snake eating its tail. And then, they have that immigration challenge over there in France as well, which is creating social and cultural problems. So like again, I find all this just fascinating to watch. And if the economy is growing, it's okay. We'll deal with it. If the economy is not growing, that's when people get a bit upset. And
Yeah,
I think that's where we're headed. Like that's the trend.
yeah, this is the trend, just to perfectly summarize it, Keith, is all these governments need a bit of austerity, but nobody, the citizens especially, don't want to tolerate and take the medicine, which is you have to sort of trim and cut back social services. Nobody wants to do that. And so, we saw this not only with several other governments, but you've seen it with, America, even with the whole Doge movement, right? Which is, okay, we cut as much as we could, which really wasn't a whole lot. And now the playbook is just, okay, let's run it hot, right? Like, let's beat the central banks over the head. Let's get them to effectively monetize our spending, our deficits. And they're going to run it hot, Keith. So effectively, they're going to get rates to zero or close to it. Like that's the trend, is rates are going to move lower. And so I have to look at it and say, well, this has to be very bullish, I guess, medium term for asset prices. No?
Yeah, I think again, I think we get two scenarios developing here. One where everyone they release this stimulus at the same time, and it can drive asset markets literally to the moon. Like boom, blast off. Of course, it just delays things a little bit longer. Or Steve, they don't get to do it in time and something else breaks first. I think playing completely one side or the other, it's going to be a high risk move if you're right or wrong with it. But that's what we have to be prepared for right now. And so the other big thing that will happen right now in the monetary world, if there is no so-called financial accident of some kind, and then the big race is how fast will the Americans be cutting rates relative to everyone else? Because remember, they have a huge cushion. I mean, they're probably what, 2.25 above,
Super, yeah.
yeah, like in that range, right? Or two, call it two, for example, depending who you're measuring it with. If nothing falls, off one of these, cliffs, so to speak, then all of a sudden the Americans are cutting faster and more aggressive than everyone else, and that's very bearish for the U.S. dollar, but incredibly bullish, for equities, in anything kind of a risk on. But again, we're at this moment where we're going to have extreme movements, and when people say, "Oh, it's definitely going to be this way or definitely in the other way," and one of them will be right, maybe, but it's again the number of outcomes. It could be something different, but people need to recognize that what's happening outside of Canada is important. And I keep going back to Canada right now. Again, we haven't had a big jobs announcement yet by a company. As soon as for example, as soon as we see one of the big banks do it, what happens next, Rich?
I don't know. Something bad.
No, they all do it.
Oh,
'cause,
yeah, yeah, yeah. Sorry,
someone
that's right.
provides, it'll start off in the credit card division or something, and it just goes down that way. So maybe, Steve, maybe Canada has a strategy coming up with a whole bunch of new projects in place and
Oh, yeah.
things.
Whole bunch of new projects. Yeah, Rich, we no deficit budget announced yet,
Which is wild.
which is good, Keith. So keep it under wraps. But we do have a list of nation building projects, Rich, was I think again we're supposed to be quarter of.
Well, has the list
Well,
actually come out, or was it leaked or something?
So I think he's announced. We're recording this obviously on a Thursday. I think he's announcing it today. But the CBC, who I'm sure gets leaked plenty of things before it's official, was of
You mean
course
the PR consulting firm for?
yeah, they got the list. Somehow they got the list.
Yeah.
So it was in an article basically, and yeah, they've effectively announced the list. No pipelines, no oil pipelines are in the nation building. So again, remember pre-election, we were told that we're going to build Canada into this energy superpower, and it's time to build. And so what we got today is a list of things that just aren't really that exciting. I'm not the energy expert, Rich. I mean, I don't know if you want to chat on some of these projects, but just kind of
listen,
reading through some of the analysis. Yeah, it looks like
go for it. Yeah,
it looks like these are projects that had this sort of, they were already kind of layups to begin with.
Of course they weren't.
So none of them are like, wow, we're gonna like just plow through and build this pipeline, and these are just layup projects that are probably going to happen regardless. But I suppose they're going to be sort of quote unquote fast tracked is the idea, anyways. But I'll defer to you.
Well, there's a couple things. Like, let's not. I mean, you know where I want to go with this, so I'm trying to pump the brakes on my own vitriol. So, I mean, it's good that we are acknowledging that we need to build infrastructure of literally any kind. I mean, we'll get to the carbon competitiveness BS later, but just in general, I think it's good. And in a way, I'm willing to, hold my criticism to see how this plays out. Okay. But for there to be no pipeline on the list right off the bat, I think is asinine. Canada, it's unquestionable. This is such an obvious positive for all Canadians, even the people who say they don't want oil. That's dumb. Of course you want oil. It affects everything that you do in this country. Now, the counter to that, which I think is really important, is Danielle Smith, who came out when this article from the CBC came out, she said it's coming. And then Mark Carney said it's highly, highly likely that there will be some kind of pipeline and that they're working with the Alberta government. So I don't know how to explain it. Like, I just, my instinct is that to not believe them at all, but I think it's a little bit too early to tell, to be honest. I don't know. Maybe that's a bit of waffle.
Yeah, I think, Rich, I think I'll give a little bit of sort of grace here to say it's probably still too early to cast judgment and say, hey, let's throw our hands up. But I mean, the early start doesn't look overly promising. I mean,
elbows up or hands up? What was the phrase?
Knees down.
Just to say, like, I believe that there will be projects. I'm just annoyed that it hasn't happened yet, which is maybe a bit unfair on my part. That's what I'm trying to say.
So I have to laugh because there was an article in the CBC, of course, when it was leaked, and sort of like the headline was, it says, quote, it says, no private company has raised a finger so far to develop an oil pipeline.
Okay, so now I can get pissed off.
Rich, why are you pissed off? Why hasn't that happened?
So that to me is super disingenuous. The reason nobody has come up to say we want to build a pipeline is because of the litany of legislation, C-48, C-69, the tanker ban, the Impact Assessment Act, the bully pulpit of John Wilkinson saying that oil demand is going to peak in 2024 or this decade. I mean, all that bullshit basically that we've heard. Of course, companies are not coming out to say, we want to build, once bitten, twice shy. I mean, that's the reality. Reality is that just like me and just like the many Canadians who think that oil is vital to our standard of living, they are dubious of this government's willingness to start pumping oil and sending it to our allies. I mean, and that guy for saying that what an asshole. Sorry. I'm sorry. I was so pissed when I read that.
You are accurate though, Rich. I mean, with that, and Steve, you would agree as well. It basically until they make it more attractive for the private sector to come into the country and do those projects, it's never going to happen. They'll go to the U.S. first.
Like,
And
I think
I have a. Oh, sorry. Go ahead.
Rich, I think the takeaway from this announcement is effectively like it's probably a little early to cast judgment, but I think it's still rather ironic that again an oil pipeline, when you're the fourth largest producer of oil, not expanding that and not having an oil pipeline is like what other country would basically do that to themselves? I mean,
Only rich idiots who live in Canada would do that to themselves. I mean, that's ultimately what it is. It's just a bunch, in my view. Sorry, I'm not going to speak for you guys.
So yeah, it's like it's saying we'll kind of see how this develops, and let's see how quickly these projects like actually get fast tracked, and they've announced like there's like another list of like sort of a secondary list of like projects they want to go after. So like we'll see, and you know the Loonie Hour here, we'll bring on some energy experts to sort of chat through some of these initiatives to see which ones are likely to be viable and actually beneficial to the country. So we'll kind of get more into the weeds and into the depths of that conversation. But
there's just one more thing before we go on. I really quickly, like, I get that it's not, oil is not the be all end all, but it is 30% of our exports. It's a massive chunk of our GDP in terms of current account balance. And funnily enough, Canada is now at a series low. So our exports of oil to the US used to be 98.9%, right? So 98%, 98.9% of all of our oil used to go to the US. And now it's down to 93.2%. Elbows up. Do you know why the oil isn't going to America anymore? Because they completed the Trans Mountain Pipeline. Thank you, Justin Trudeau. And so it's just amazing. Like, we have real time, like literally you can see on the chart what happened, why, and the results. So building these pipelines does actually literally take pull us away from the United States from an economic standpoint. Anyways.
And so that sort of goes back to, you know, that collision theme that I introduced earlier on the political ideology side. And, you know, we are clearly stuck in this like bizarro world in Canada as well as elsewhere as well. But that's the one. And Steve, maybe you might want to share next, or Rich, what sort of another big announcement came out this week that further just confirms that we're still in that world. Like, it's not like, for example, the Canadian competitive advantage that was announced.
So Carney had a press conference, and again, this is just kind of something we've been talking about, and we know that we get a lot of feedback from our audience and says, you know, it's important, we still need to like focus, and we get it, but like, yeah, he basically did a press conference yesterday, basically talking about, you know, Canada with these sort of energy announcements is going to be, it's all about climate competitiveness. He probably said it 15 times in an interview. And yeah, I mean, again, I think for Canada being a rich, call it what it is, a natural resource.
Of course.
It's an oil based.
We're an extractive industry. Yeah.
That if I don't know, I'm struggling to see if
there's going to be a new degree offered now coming up, a PhD in climate competitiveness.
Guys,
in a way, though, again, this is bizarre. This whole collision thing I'm talking about, it's going to be over soon. And this is what contributes to the acceleration behind it. Canadian economy cannot grow with this kind of thinking.
But it's gobbledygook. But I kind of, upon reflection, I kind of get it. It's gobbledygook because Canada's 1.6% of global emissions. And if we wiped, every single Canadian was wiped off the face of the earth, it wouldn't make one lick of difference to global emissions because China continues to build hundreds of coal-fired power plants. And that's not even including Asia, Indonesia and India, blah, 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 blah. Okay, so that's it's total bullshit. But I kind of understand because I think that there's a growing number of MPs in that caucus that are desperate to keep their climate bona fides and not be seen as environment sellouts. And I think that this is maybe, I'm being very generous here, but I think this is maybe a way of sort of keeping the tent open enough and big enough to have these people in, which is giving them some of this fluff, basically, in terms of like climate competitiveness technology while doing what is right for Canadians in Canada. That's my generous view on that. Who knows?
Yeah, well, Rich, just while we get, and then we'll shift gears, but we talked about it. We had a couple guests on, I think, over the last year and a bit, but we noticed that quietly behind the scenes, the 2026 EV zero emission targets were quietly scrapped. Remember, the targets suggested that by 2026, Canadian car manufacturers would effectively have to sell 20% of their sales would have to be zero emission vehicles. That was quietly scrapped last week. Now that I think they still technically haven't gotten rid of the 2030, which is it all? Is it?
Yeah, it was no 2035 was 100% of all new cars were meant to be zero emission vehicles, which by the way is categorically insane. Never ever going to happen.
Which, well, yeah, again, to the point that we've kind of been emphasizing here, and this all ties in and correlates, and this is why we said, listen, this is never going to happen, because what we're seeing in real time is you're seeing the Canadian economy weaken, you're seeing people lose jobs, you're seeing people really grasping with the cost of living crisis, and to sort of impose these mandates. I mean, the reality is the electrical vehicles, they're great cars, but they're expensive and they're not viable in many parts of the country. And so it was never going to happen. And that's why, the Loonie Hour was early to call it out over a year ago, how ridiculous these targets were. And I think we're seeing that sort of play out in real time. But
don't you
I think
just
this
listen to ourselves. Let's see how ridiculous we sound. 30 seconds ago, we were talking about Canada will be a climate competitive country. Is that what we're looking for here?
We're aiming.
And then at the same time, we can't reach this, 2026 goal or something. And we still charge enormous tariffs on the Chinese EVs that want to come in.
Oh, that was actually Keith. You beat me to
fixed?
it. No, so they're again. I think it was, man. These guys are getting everything. CBC got another leak. Apparently, the Carney government is
investigative journalism.
Dude, it's an arm of the Liberal government. Of course, they're getting the leaks.
No, they are rolling up their sleeves and working hard at it.
Yeah, apparently there's internal discussions about the possibility, potentially, of the Carney government removing the tariffs on Chinese EVs.
We also had, though, I know people don't like the political stuff, but guys, we got some really weird policies in Canada and other countries as well, and this is one of them. But I think a few days ago, we came out and the Canadian government, they announced, again, climate is now suddenly way more important than becoming a 51st state. They just keep going around and around. And if they really wanted Canadians to use EVs, maybe they will let Tesla come back in again and give people credits for it. It's just weird stuff that's happening.
I just want to provide some context about the EVs. So it was always bullshit, but let's look at the numbers really, really quickly. So in Canada, it's quarterly data. You're welcome to look it up. In Q2 of 2025, those 541,000 total vehicles that were new vehicle registrations. Of those, 405 of them were gasoline, 24 diesel, 65 hybrid, and all zero emission vehicles were 46.4 thousand. It's about 8.5%. I only know it's 8.5% because I can use my calculator really quickly. Loonie Hour math. So, and that is down from what was basically 11%. And it fell because of all the subsidies were pulled away. Who buys? So the idea that we were going to go from 8.5%, or let's be generous, 10% of new vehicle registrations to 100% in 10 years with zero subsidies, because remember, only rich people buy new cars, old people buy used, poor people buy new ones, old ones rather, and without any of the infrastructure to charge any of them, was always crazy, right? So it's just nuts. But anyway, so there you go. Those are the real numbers. Happy to share the chart. If you follow me on Twitter, you can find it.
Yeah, so I'm reading an article in the CTV. It says Ottawa considering scrapping tariffs on Chinese electric vehicles. According to a Nano's research survey, 62% of respondents either support or somewhat support removing 100% tax on all Chinese-made EVs in hopes that China may remove tariffs against Canadian crops like canola. And then this goes on to say the agricultural minister said Tuesday that a decision to scrap or ease these tariffs is currently under review. So I'm sure that if they do, that will make our neighbors to the south not very happy.
And I love saying this. If climate was really the number one threat for the world, you wouldn't care about canola tariffs. You would have all the EVs come in. You would just do it. Come on. I got a challenge, guys. This thing went empty. What happened there?
If you read the reviews on BYD, People love them. just
Yeah, I
say
mean,
Okay, let's move along. Let's move
Yeah.
along. So we
Yeah.
have employment. We've gone through the inflation data next. Is that the
yeah, well, Keith, I mean, I kind of wanted to bring it back because obviously, we've talked about it off the air. The political stuff is just a waste of time ultimately. But I still am fascinated about sort of the setup here for financial markets. There's been a lot of discussion in the media and social media over the last month or two about, the BLS, the US jobs data. It's not that good. Is the Fed should be cutting? Trump calls them too late, pal. And we had some big revisions this week, Rich. I think we had the BLS came out with their massive revisions to the jobs data. I think they effectively wiped out 1 million jobs. They said, oh, we probably overcounted by 1 million jobs.
Yeah.
Is that the right number?
Yeah, I'm trying to dig up the number here first. Sorry. I mean, how about this? I'm gonna defend the BLS and say it is a difficult job to do this, but they wiped out 1 million jobs. So so the annual benchmark for revisions over the last 10 years had an absolute average of 0.2%, and this decline was 0.6. So 911,000 jobs were removed. That is an enormous revision downwards, and that's followed by an enormous revision in 2025. And normally,
Rich, weren't these like some of the largest revisions in the last over the last 20 years? I think it was like top three.
Yeah. So the last two revisions of 2025, which was 911, and the downward revision of 2024, which is 818, I think, or whatever it is. Trying to find my chart. Oh yeah, here it is. 818. Plus there was revisions in 2023 of 306,000 downwards. Those are the three of the four biggest in the last 15 or 20 years. Now, to be clear, normally you get these big swoops in data when you have significant declines in economic activity, right? Because so for example, in 2020, 2008, 2009, you had big sharp declines in employment, and then you have big revisions later because it's hard to, when things are going steady and slowly, it's easy to count. When things are moving really quickly, when there's lots of volatility, it's more difficult to count. And that's what makes the last couple of years so crazy. Right. So so think about that. In 2020, it made sense. It was difficult to count jobs because you went from an economy that was ripping to an economy that stopped immediately, what makes the revisions kind of particularly jarring in this scenario is that the economy was just ticking along. It could be bad, it could be worse, but you know what I mean? It was just ticking along. And so that is not good for all kinds of things. I mean, faith in the numbers, politically, there's obviously an angle, et cetera, et cetera.
Yeah, Keith, this comes back to your earlier comments on just sort of the social frictions and all of these things colliding, which is, obviously there's two sides of the coin, but there's the people that are on sort of the Trump side of the coin are saying, holy smokes, this effectively means there was no job creation in the last year of the Biden administration. The Fed has been, if this is true, the Fed really should have been moving probably a while ago. And so, yeah, I just think it's what's interesting and the most fascinating is just to sort of see the political and social frictions developing here. And
it's funny how that one worked out, hey? Apparently, the economy wasn't as strong under the previous administration, and now the table is set for the Fed
sharp
to
as a
cut
tack.
rates. Yeah, absolutely. I think and the initial market reaction is, oh wow, maybe we're going to a recession. So long-term yields came down aggressively. That's the normal reaction to that. I think this is going to flip on a dime.
What do you mean?
Well, if all of a sudden the economy does start to slow down aggressively, whether it's for the Americans or Canadians or French, it doesn't matter who, all of a sudden the deficits get blown out of the water. So they have to borrow even more. And then it becomes this global fight, for capital. Hey, buy our bonds. No, buy our bonds. And because it's all happening at the exact same time, I think we're going to see this situation where, again, because remember, we haven't had a normal cyclical recession for a really long time in Canada, especially. You got to go back to the 90s for it to happen. And I think a lot of weird things are going to happen, and you're gonna see it in the bond market first coming up.
There's an interesting comment here that was circulating on the internet. And I'm not sure how much stock you put into this, but it says, so again, the U.S. economy reportedly added 911,000 fewer jobs than initially reported through March of 25. Yet in first fiscal quarter through March, U.S. employment receipts were up 7% year over year. Those are cash receipts. So is this the potential smoking gun or argument that inflation is running well above reported official inflation?
Are you saying that
employment receipts
income tax revenues?
Employment receipts. So basically, employment receipts, revenues, taxable revenues off of.
So even though employment
jobs,
wasn't as strong as what they expected, it was still up at a healthy
clip.
It's
up 7%.
Yeah, it's a bit weird.
I don't know. It does kind of make you think. It does make you think.
There's a lot of things going on here, guys. And the other phenomenal thing that you're going to see happen here is that all governments are going to start issuing debt at shorter and shorter durations. Because it's at lower and lower rates, lower interest expense, applied to their budgets and so forth. And then everyone around the world is issuing at 1 and 2 years. And who's going to buy this stuff?
No, I don't want to buy them.
When I point at you, Rich, you're supposed to answer.
I don't
like
want to
Moneyball. You're Pete. No. There's one guy going to buy it. Yeah, absolutely, Steve. Yeah.
The banks.
I think QE is just going to go through the roof. And then you go back and say, okay, what happens when QE happens? And it comes back to, did anything break before? If it didn't, and QE start going nuts with,
okay, but
risk on markets are going to go vertical, to
Keith,
the moon.
But can I think to stress test that view. Where do you think you could be wrong in that scenario? Where do you think that might not play out the way you've sort of outlined? I'm not saying I disagree or agree. I'm just trying to, because I know that's really important. We can't just be only one-sided about this. There must be a scenario where your hypothesis doesn't sort of play out.
Yeah, I think, again, with us, we're not all in on it's going to happen this way. So this is what I'm sure of. We're going to get a financial bazooka on the fiscal side. We're going to get a monetary. So by that I mean is that governments are going to come out and spend so much money. It doesn't matter. They're going to spend it on everything and all things. And I think central banks are going to be cutting rates to try to save jobs, help commercial banks with their loan portfolios. And then at the same time, you're going to see QE coming in through. So where this might go wrong, it's not what goes wrong. You're going to get two scenarios, Rich, is that either there's no financial accident and they do this beforehand, so they're proactive. And then that just simply pushes everything, finally, for example, at the end of 21, I think M2 growth reached its peak and fiscal stimulus reached its peak. And that's why 22 was such a crap year in markets. Mm-hmm. So then the same thing will happen with this next wave coming up, or we get an accident beforehand and they're being reactive to it. But the response in each one, it's not great for the bond world. So if you go back and look at the when all the QE was being issued back in, call it 2010 and onward, equity markets and real asset markets are great, right? It was a great place to be. Not so much for the bond world.
So the challenge that I have with that is that, the bond market is increasingly worried about a recession. And the 10-year, for example, has had a great month, frankly. You've had a situation where equities have rallied, gold has rallied, and the 10-year bond yields have rallied. And so, if we're really worried about the fiscal position of the US and we think the budget deficits are going to blow out even more and they're going to cut, why is the 10-year rally? In Canada, for example, the 10 years, the whole yield curve has basically come down, right? Short-term rates have come down and long-term rates have come down. And that's actually different than what we've seen over the last 8 months, right? Most of this year, you've seen the front end come down and the long end go up. And in the last month or so, we've seen the whole yield curve come down together. Is that just a blip? What do you think about that?
Well, because there's been no accident of any kind. The market is acting as if we're going to get a recession coming up.
A normal one.
And I'm saying, well, we get any recession. Again, the deficits are going to explode higher.
I mean, they're telling us that. I mean, they're
What they are. I mean, they're
They're not hiding it.
but they're literally if we get a recession, doesn't matter if it's the Canadians or the Yanks or the Brits, it doesn't matter. The deficit is going to go up exponentially because all the debt rollovers are coming and new issuance. And then you're going to say, okay, well, yeah, maybe the bond market is a safe place to go. I just think we're headed for this experience where they're not ready for it yet because it hasn't happened over the last 40 years. It's going to be sensational. It's just going to be in a really weird, wicked, maniacal laugh.
voyeuristic kind
Governments,
of way.
governments are not ready for what might happen here coming up.
I think that one of my favorite sort of follows on this is a guy named Michael Howell. Keith, you probably know him, Michael Howell. He does. He basically tracks sort of liquidity. So he tracks sort of credit conditions, liquidity. That's kind of his shtick. But he effectively just calls it effectively a refinance scheme, right? Which is like all this debt globally needs to be rolled over, and you can kind of see this wall of maturities that need to be effectively rolled over and refinanced. And central banks, they might not be telling you this, but they know this. And it's sort of a coordinated effort to make sure the debt effectively gets rolled over and to keep the system going. And so you've got these wall of maturities that are coming up for renewal globally.
One thing that people think about, so let's say we're a pension fund and we hold a 10-year bond, we bought it. It doesn't matter what the yield was when we paid for it. 10 years later, it matures. That 10-year matures. People think that, oh, well, no one's going to buy it. That's not the way it works in the institutional world. That at maturity, that money is immediately reinvested in that same market again. It may not be a 10-year, it might be a 3-year or 15-year, but so Steve, that is right. You always get that consistent rollover of money going back in, but it's that incremental increase. Is that the margin, and that's where the deficits come into play. If they have to start increasing more and more debt, and becomes more of a, rich's favorite term, that's a zero productive investment of our tax revenues. That's when you get this French situation happening, and it just collapses, from the weight of itself. And that, again, this will happen. Is it next year? Is it 10 years from now? I think it's closer to next year than 10 years. And that's because it's happening everywhere at the same time. And that's why it makes it just so interesting, to follow all this. Yeah.
What's so fascinating about Canada, though, is unlike some of the European countries that have a much more uniform distribution of that debt. So the UK is in trouble because they just have too much debt and they're not productive, and a lot of it's interest, inflation protected and whatever that. But if you compare like the Canadian experience, which is 30% of our debt needs to be reissued over the next, so 30%, I'm looking at it right now, needs to be 30% of the federal debt outstanding needs to be reissued over the next year and a half.
2 years.
Basically.
Yeah.
Next 2 years.
And that's where I agree with you. Yeah. Sorry to interrupt you. That's where the British situation is different. But that's with the Brits, though, because the maturity schedule is way better than what the Canadians have. However, they're the ones who are really up on deck here.
I know.
But that's why, I'm not joking when I say this to Ottawa. I'm being serious. Don't release the budget. And people say, "Oh, that they have to." I'm telling you, they could release that on the exact wrong day of the week that's coming up.
Yeah, it's a Liz Truss moment.
Yeah. You just don't know. You don't want to be the first one.
Just to finish up, Keith, it was so for the next, though, there's $1.4 trillion of debt that's the federal government owes. Again, let's leave aside the provincial. 14% of the debt of 2025 debt needs to be rolled over in the next however many months. You got another 19. So Loonie Hour math, that's 20 That's 33 and or
410
31.
billion.
I don't know. Anyways, so you got 43% or 40 odd percent, let's just say, to be generous, of the debt that's outstanding needs to be rolled over in the next 3 years. And for Canada.
And I betcha if nothing has stopped, they're going to roll it over at 2 years, 1 and 2, 3 years.
And so, yeah, I think Steve is right.
Because they want the bank. I mean, the Bank of Canada's getting the same call that the Fed is getting. Yeah, lower rates. We need you to lower rates.
Yeah. And just to give you, one last thing, just the context, which
Ford's
is
certainly making the calls.
Yeah, the U.S. is 20 for 2020, so 35% for the U.S. Over the next 2 years.
How much, Rich?
35%. So 21 in 2025 and 16 in 2026. So it's called 35% over the next 2 years of U.S.'s debt need to be rolled over. Contrast that Sorry, go ahead.
Yeah, sorry, Rich. Have you looked at other countries? You should put that together for all countries. Yeah.
Yeah. So I have. Sorry, I should just send it around. So but you can see for the UK it's 10%. For France it's about 10%. I mean, they have their own issues. It's not quite a comparable economy, blah blah blah. But just it's amazing. Like a lot of debt needs to be rolled over. And the difference between Canada and the UK is that the UK's interest rates have gone up way higher than Canada's. So they have a smaller amount of debt, but their debt payments are going to soar anyway.
Quick ice cap meeting. Rich, do that for the provinces as well.
I've tried to. It's way harder to do that for provinces.
Okay, meeting is over. Steve, back to you.
Yeah, I mean, Rich, ultimately, just to kind of summarize here, this is setting ourselves up for the Fed. When is the Fed on deck?
Oh, I had it, and I fucking got
it. Anyways, they're on deck here this
next
month.
Week as well.
Yeah, but Rich, we had I think so. Not only we had the massive job revisions.
Same day. Oh, sorry.
Same day.
Sorry. Yeah.
Okay. So we had the massive job revisions. We had U.S. CPI and producer price index was out, I think, yesterday.
Yeah. So mixed messages.
Yeah. Well, I mean, effectively, I think the summary there was it gave the Fed just more of the green light to ease. But I mean, correct me if I'm wrong. I don't know if you had a different takeaway.
No, I mean, the reason I say mixed messages is because PPI was like very bad. Well, quote bad in inverted commas.
Which is a little bit counterintuitive because people will say, well, producer prices should be going higher due to all the tariff stuff.
Yeah, wow. It's because I think a lot of people who were talking about the tariff shit have Trump derangement syndrome. Again, and as someone who does not support tariffs, it was never clear that it was inflationary because taxes are not inflationary. Taxes are anyways, conversation for a different day. The reason I say it's mixed messages is because if you look at goods, which if you look at the services X rent of shelter is 4%, and the services ticked slightly down, but the goods component went up. So in general, headline inflation is 2.94 in the US, and core is 3.1. I remember 3 years ago we said this. We said 3 is the new 2, and we were joking about that kind of. And it's for US and Canada. I think we nailed that. 3 is the new 2. I think that's why they're cutting basically.
Well,
there you go.
Higher inflation.
Hey, anyway. So guys, sort of back where I am here. There's one of my favorite climbing writers, a guy named John Krakauer. He's an American, and one of his first books was called Eiger Dreams. So it's a collection of short stories he wrote for Outdoor Magazine. But the very first one is about his attempt to climb the Eiger. And that's where I am right now. I'm right basically underneath the Eiger. So check out this short story on that one. He's a great writer, but you get a feel for the climbing world. And so the Eiger is probably one of the most dangerous mountains in the world. The north face is called the Murder Wall. And yeah, it's just outstanding. But check out that John Krakauer, Eiger Dreams, and it's just a collection of short stories that will make you chuckle. There you go, Steve. That's a wrap.
Wow, what a way to wrap it up. Yeah, just to summarize, we got the BOC cutting on the 17th. We'll probably look to do some sort of commentary such analysis, potentially maybe on Twitter X there, to be determined. But BOC cutting, the Fed will be cutting almost certainly the same day. We've got a setup here for central banks to continue to sort of cushion large fiscal deficits in the months and years ahead. So we'll continue to watch, monitor. As always, guys, appreciate the support. If you found this episode valuable, entertaining, all we ask that you share with one friend or family member. And as always, we'll see you next week.